Hi, good evening, everybody. Very warm welcome to today's session. I welcome you on behalf of the Board of Internal Audit and Management Accounting Committee. Today's webinar, which is 28, covers fraud risk and internal audit. And for this interesting topic, we welcome our speaker for today, Ms. Archana Mogha. Thanks a lot, madam, for taking time out for the session. A brief introduction before we pass it over to Ms. Archana for the insightful session. Ms. Archana Mogi heads the internal audit function at NIIF Infrastructure Limited. She's an internal audit, fraud prevention, and investigation professional with over 25 years' experience. She has worked with leading banks and financial institutions, including HDFC Bank, Axis Bank, NCPI, and Bombay Stock Exchange. She is also a recognized leader and contributor in the field of internal audit. Ms. Archana is a qualified chartered accountant, CISA, CFE, and diploma in IFRS from ACCA UK. And she's also an active speaker in various seminars, conclaves, roundtable organized by ICAI and WIRC. So I welcome Archana ma'am again. Thanks a lot for accepting the invite, and I pass it over to you for the session. Thank you so much.
Thank you, Aditi. Thank you for this opportunity to address ICI members on internal audit and the very interesting topic of fraud risk. So we can get started right away. I will just share my screen. Aditi, is the screen visible?
Yes. Yes, it is.
Okay, just a request, in case at any point of time the screen is not visible or something, you can just call me or ping me during the course of this discourse. Yeah. Okay. Well, a warm welcome to everyone, and thank you for joining this session on fraud risk and internal audit on a holiday. So let us get started. Just a disclaimer before I start. This disclaimer is for informational purposes. This presentation is for informational purposes only. It doesn't constitute a legal or professional advice, and the views expressed in the presentation are my personal views and not representing the views of my employer or any client or any other authority. This is the agenda. So I thought that instead of making it, a descriptive kind of a session, I thought let me take 2-3 case studies. Let us look towards the West and what is happening in other countries, to take a look at what is happening really in the world of fraud risk and internal audit, and how internal audit can help detect the fraud risk and also prevent the fraud risk. That is what we are looking at now. Like, we are looking more at prevention rather than detection. But yes, detection also and investigation is also an important part, and more regulators are assigning this responsibility either on the external auditors or on the internal auditors, because they are the best fit to do any such investigation. So here we will have a look at 2-3 case studies. One is the cryptocurrency verdict, which happened sometime last year. The sales misconduct related verdict, again, it was a very renowned bank wherein this misconduct has happened. And, anything and everything now, goes through the system ultimately. So earlier we used to audit reports from the system. Now we audit the system itself is subject to audit. So we'll have a look at the tail of the leaky app. And obviously, greenwashing, it's the most important concept nowadays, given the importance of ESG and other disclosures and the auditors' assurances which get attracted because of these disclosures. So let us take a look at the crypto verdict. Yeah. So before we start, let us learn the basics of what constitutes a fraud. So as per Section 447 of the Companies Act, fraud in relation to the affairs of a company or a body corporate includes any act, omission, concealment of fact, or abuse of position committed by any person or any other person with the connivance, with an intent to deceive or to gain undue advantage. So the important aspects are any act or omission, concealment of a fact or abuse of position committed by a person or any other person with the connivance and with the intent to deceive or to gain undue advantage. So these are the three important aspects. So fraud is essentially a fraud triangle. So basically three elements are of utmost importance. One is the opportunity, knowledge and ability to carry out the fraud. Second is the incentive or the pressure. It can work both ways, motivation or the incentive to commit the fraud. And third is rationalization or justification of dishonest actions. Okay. So the major categories of frauds, it is out in the report to the nations. The Association of Certified Fraud Examiners comes out with a report to the nations. So these are the major categories of frauds, which is accounting manipulation, corrupt practices, cash embezzlements, fraud in computerized environment, financial leakages, and financial crimes. So as an internal auditor, okay, and fraud investigator, there are differences because internal audit is more broad-based and fraud investigation is more deeper. Okay, so a good fraud investigator is the one who thinks like a fraudster. So it's something like, hacking, like if you are doing an ethical hacking, then you can strengthen the system. In the same manner, like a good fraud investigator is one who can think like a fraudster, like what can go wrong kind of a mindset and what are the vulnerabilities. So if he is able to find out the vulnerabilities and think like a fraudster, then he is able to identify like what are the preventive measures also. Okay, so this is the case study from the US, which is called as a FTX, and the founder and CEO, he was a very renowned person, graduated from MIT. There was a liquidity crisis which led to the bankruptcy of this company in November 2022. He pleaded as not guilty in January 2023. But again, in November 2023, he was convicted for fraud, for stealing at least $10 billion and investigated, of course. So Sam Bankman-Fried, he was found guilty on all 7 counts and he faces a sentence of maximum of 115 years in prison. So now what exactly happened over here? Let us take a look at this. Yeah. Sorry, just a moment. Yeah. So what exactly happened? So let us take a quick look at what exactly happened. So in this case, there were representations to the investors and Bankman, who had promoted this company. He was responsible for the crypto asset trading platform. And there were automated risk control measures. So there were some systems in place to protect the customer assets. Now, there was a complaint that in reality, there was a year-long fraud to steal things from FTX investors, like the people who invested in the cryptocurrency. That there was diversion of funds. So diversion of funds is the the most common kind of fraud which is generally found. And there was a diversion of funds to Alameda Research LLC, and the undisclosed special treatment to Alameda, which was a group entity only. included providing Alameda with a virtually unlimited line of credit. And that line of credit was funded by the cryptocurrency customers. So because of which Alameda was exempt from certain key risk mitigation measures. Now, this undisclosed risk stemming from the FTX exposure, significant holdings of overvalued liquid assets. The complaint also alleged that he used commingled so there was mixing of the funds and the ring fencing wasn't there, because of which the FTS customers' funds were used to make investments at Alameda. Okay. And that in turn was used to purchase real estate, and it went into political donations as well. So also the systems guy over here, and Mr. Nishad Singh, he was also convicted. And Singh, he was the software guy, and he had created the code that allowed the customers' funds to be diverted to Alameda, which was a crypto hedge fund owned by, again, it was owned by the group itself, that Sam Bankman-Fried, and one of his colleagues. Despite so Bankman assured the customers that this was a safe crypto asset trading platform with sophisticated risk mitigation measures. However, the software code did allow all these funds to go to the group company. Okay. And it just said that Alameda is just another customer, but actually the software allowed all these things. So Singh was also convicted because he knew that this is what the software was doing. However, he did not, counter these false and misleading statements. He was in turn an active participant in the scheme because he deceived the investors, and it alleges that Alameda and FTX could not make customers whole for the funds already unlawfully diverted. And in fact, he directed thousands and millions of dollars in FTX to Alameda, and later on he himself withdrew around 6 million from FTX for the personal use and expenditures, including the purchase of $1 million house and donations for charitable purposes. Yeah. So this is what has happened. Now let us take a look at what were the red flags in this case. Was there any oversight? What was the role? Was there any audit team, or was there something wherein the audit team had highlighted? Okay, and what is the big deal? Why should we care? Okay, so let us look at all these things. So basically, what went wrong? Okay. So obviously, oversight wasn't there to the extent that it should have been. The red flags, yes, there were lack of financial and accounting controls. And FTX learned in 2020 that to be listed, the company would need to have its policies and procedures audited. Senior management scrambled to fraudulently make up the policies. So what it did is it couldn't make up the policies. So in 24 hours, all the policies were drafted. Obviously, nowadays we have all sorts of, ChatGPT, OpenAI, and it's not a big deal to draft any policy, right? So 24 hours they were drafted. However, it was only in the literal sense and not in spirit. The majority of the accounting, secondly, was conducted by a small external firm, okay, which the then CEO, the subsequent CEO said had no specialized knowledge relating to cryptocurrencies or international financial markets. So from here, the red flag was there were no specialized accounting controls, no specialized risk professionals who could help to safeguard the organization from internal and external fraud, okay, and provide oversight control. Key documents including cash flows, statement of equities, and intercompany and related party data did not exist, or they weren't prepared. Expenses and invoices were submitted on an online chat platform, and supervisors approved it just via personalized emojis. Messages sent on chat platforms and secure messaging apps were used to process approval for transfer of tens of millions of dollars. So FTX has difficulty understanding even its own positions. A June 2022 portfolio summary claiming two model cryptocurrency positions held by Sam Bankman-Fried Almeida's hedge fund stated with respect to the valuation that personnel should come up with some numbers. So basically, the numbers also were delayed. They were not coming up on time, and they said they should come up with some numbers. I don't know what numbers. Okay. Then Sam Bankman-Fried himself acknowledged the situation, writing in an internal communication. So there was enough evidence that there was an internal communication that Almeida was hilariously beyond any threshold of any auditor being able to even get partially through an audit, adding that we sometimes find $50 million of assets lying here around there. We have lost track of it. Such is life. So, which is, completely not acceptable kind of communication. $50 million of assets are coming here and there, and it is not accounted properly. So, and that the companies with operations as large as FTX, they were using off the shelf, they were using some small medium sized firm use such softwares which were like QuickBooks and all, and instead of using renowned softwares like Oracle or SAP, which is generally used for that kind of operations which can be used to scale up. So that was the other thing. Third is the entities within FTX did not produce the financial statements of any kind, whereas 35 entities used QuickBooks again, which is generally used by small and medium sized businesses. The then CEO, John Ray, what he said is, Bankman took multiple personal loans from his trading firm. Now, these personal loans were taken, and he himself was both the issuer and the recipient. He signed on both the sides. Okay. And Bankman told regulators he reinvested the money back into the exchange. But as such, there was no documentation of what the loans were and how they were used. So there was no evidence and trail again for all these kind of transactions. So the third thing was there was no distinction in the leadership between FTX and its US arms and the trading firm Alameda, and that the owners could just run free without reporting all these transactions. Coming to the next point is, well, these red flags were there, but how could audit have helped? So FTX group lacked the management oversight and governance. So this is something which could have been pointed out during internal audit had there been an internal audit division. There was no independent board to serve as a watchdog. There were lack of accounting and financial controls. There were absence of experienced personnel for financial reporting, risk management, auditing, and accounting. There were generic policies, and the policies were non-existent. They were just generic and just made up at the last moment for the SEC filing. And the most important is the related party or the intercompany transactions. There were also no formalities for intercompany transactions, allowing liabilities and assets to transfer between insiders and FTX Group's entities without any documentation of checks and balances. So this entire thing, it just fell off like a house of cards. Governance and risk management practices should have a place in every company, regardless of size, and especially this was a SEC listed company. They may be simple, but these practices must grow and become sophisticated. Otherwise, the entire thing can fall like a pack of cards if the governance processes are not strong enough. And again, the important point is lack of governance. You cannot give lack of regulation as an excuse for lack of governance. So governance is a must, no matter whether regulation is in place or not. Just because it's a new field, it's a new area, and regulation has not been frozen or it is still evolving, does not mean that you can have lack of governance. And the fourth point is the management of the company is charged with enacting governance and internal controls. So that is the management responsibility to ensure that they have governance as well as internal controls in place. Uh, so let us take a look at what were the lessons learned in this case. The first was that governance and risk management was not there, so there cannot be an excuse. Then there was the people who lost the money. They were because of the fear of missing out, and uh, uh, the promoter, which was Sam Bankman, he had some kind of star power and charisma, but the people had the fear of missing out that yes, a lot of money can be made out in the crypto, and if we don't enter into the market, then we will lose this particular opportunity. Absence of independent due diligence, yes, that was very much there. There was no external nor internal verification. Uh, the external verification which was there was not up to the mark. Thirdly, the responsibility for enterprise-wide risk management. So there were more than 130 companies, but no centralized responsibility for risk management. There was no context for the bigger picture, and whatever was done in silos, and the interconnectedness of the risk was absent. Other lessons learned are, the relationship between management and the board. There should be a culture of accountability, oversight, and transparency. Secondly, the risks should be assessed and develop processes for early warning signs. No business process cannot be accepted. I mean, it is a early warning sign that there is an issue. Secondly, the risks that could go under or kill its top risks that could go under or kill its reputation have to be identified. So risk assessment has to be there. Thirdly, share cultural stories to learn from mistakes. So there has to be a group wherein you share cultural stories to learn from the mistake, golden opportunity for fruitful discussion, examine what's different in the organization and create a bond of purpose and integrity. Learn from risk management practices and not repeat the mistake. So this is more of a cultural thing, which is useful and useful to multiple people in the organization, so that people learn from that, and they take steps to implement the learnings and put in the necessary controls. So this is very important. Examine what's different and create a bond of purpose and integrity. So that is more of a cultural thing, and learn from risk management practices and not repeat the mistakes. So let us now move on to the next case study. So in the last case study, we have lots of learnings, mostly from the internal audit point of view, that internal controls were lacking and policies, procedures were not formalized, governance was absent, and red flags or early warning signs were not looked into, like absence of the processes were not looked into. Also, the scale of the software, the kind of software which was used was not up to the scale which was expected of a company of that stature. Yeah. With respect to the next case study, let us take a look at the agenda. Some recent judgments and developments. Important experts excerpts from the judgment will be looked into. Okay. This is again a case of a reputed bank. There were critical aspects in this particular case pertaining to gaming, wherein the employees and the sales employees tried to game the system. Issues were identified, however, they were self-identified, and therefore the auditor had not reported it. Okay. Thirdly, there were escalations, suspected fraud was there, and also there was an issue with audit rating. Okay. Audit rating was mentioned as satisfactory, and later on, there were lots of issues found. Then what is the regulatory action, environment, and call to action? Okay. So in this is a recent case of the US OCC, that is Office of the Comptroller of Currency, OCC. So what exactly is OCC? OCC is the Bureau of the US Department of Treasury, and the charters, regulates and supervises all national banks, Federal Savings Association, and federal branches and agencies of foreign banks. So OCC ensures that the banks they supervise operate in a safe and sound manner, provide fair success, treat customers fairly, and comply with the applicable laws and regulations. So it's a regulatory body. So the OCC has, passed on. The judge has the recent actions by the administrative law judge for the OCC has passed the judgment. The judge recommended stiff penalties against three former uh, Wells Fargo executives, which is the CRO, CAE, and the internal audit director, over sales misconduct at the bank. Okay. The CA is being slapped with $7 million fine and audit director with a fine of $1.5 million. The fine against the CAE and internal audit director is for failure to timely identify the root cause of the team members' sales practices misconduct in the community bank and provide credible challenge when evaluating the effectiveness of community bank's risk management control. And also, he failed to identify, address, and escalate risk management control failures that threatened the safety, soundness, and reputation of the bank. So, these were the charges against the chief audit executive. Now, let us take a look and examine this in detail. So, where did it all start? So, it started sometime in 2013, uh, almost 11 years ago. Okay. Wells Fargo. There was an article in 2013. Wells Fargo accuses workers of opening fake accounts to meet goals, and pressure cooker sales culture comes at a cost. Okay. So where it all started, this is where it started, and it has taken quite a while for the judgment to come. But that was a kind of a a red flag, and there was a whistleblower in there. They put their own addresses on the accounts, so he wouldn't know about it. It showed up on his credit report. That's how he found out. So basically, customer's name and address, okay, that was fudged, and own addresses were put for the customer. So the customer, but the name was of a different customer, and account was opened in his name, but he never came to know about it until and unless it showed on his credit report. This is how he found this. Okay. So they tell the customers, you're getting a credit card, and he admitted to opening unneeded accounts, though never with the customer's knowledge. So customer was totally unaware, and he would get a credit card. They'll tell the customer, you'll get a credit card. When the customers complained, like, why am I getting this credit card, I don't want it, then the branch manager would say that, okay, there's another customer the same name, so because of a computer glitch it has come to you, and so apologize for that. And obviously the customer's credit report it should show. So someone said, I have a 6-figure line of credit. I don't need a credit card. I don't want another account. Okay. But they used his birth date and social security number to open account in his name and open fictitious accounts. And it said that at least one of the employees forged his signature several times, because without forgery, it was not possible to open account in his name. Next is in one case, the manager would greet the staff each morning with a daily quota for products such as credit card or direct deposits, and you would give that this is what you need to do on this day. And to fail meant staying after hours, begging friends and family to sign up for services. So you'd say, I don't care how you do it, but do it, or else you're not going home. Branch and district managers told him to falsify the phone numbers of angry customers so they couldn't be reached. So basically, two customers are angry. Okay, fine. Use their phone numbers, use their credit history, use their names, and get cards on their names, because any which ways they are not going to, come back for the bank's satisfaction surveys. So there won't be any complaints. Employees would often open premium checking accounts for Latino immigrants. So these accounts were open for Latino immigrants, and enabling them to send money across the border at no charge. Okay, so basically, they got lots of these immigrants. They opened the account, which were premium account, and these accounts could be opened with just $50. But actually, these premium accounts were supposed to have at least $25,000 on deposit. Okay. So they didn't have that. Within 3 months, there would be a monthly charge. So basically, it opened as a premium account, but it was used as a basic account. And within 3 months before the charge used to apply, they used to downgrade the account, okay, to get around the requirements, and then open new premium ones before the fees kicked in. So this was the modus operandi. The customer, surprised by the unrequested credit line, said she went to complain where the account was open without her knowledge. The manager told her that the person was one of the branch's best employees. How is that possible? And the customer said, yes, if this is the case of the best employees, then the company is in trouble. So now there were lots of issues in this case. So let's take a look. It's mostly related to sales. Let's take a look at these sales integrity issues. And this is the reason that the internal audit plays a crucial role over here. Allegations of the booking or sale of any banking product without the knowledge or official direct consent of the primary customer and joint account. So customer consent was not taken in most of the cases. Then there were some wrongdoings pertaining to false entry violations. So false entry is false identification, false expiration date, false information to open the account. So the false entries, incorrect data was used. Some mix and match of phone numbers and date of birth was used to create some synthetic IDs. The third part was fictitious customer. In fictitious customer it includes any product application wherein a falsified identification or SSN or social security is used to mask the true identity. Basically, the customer doesn't exist, okay? But you use a mix and match of IDs and create a synthetic ID. Fourth is the online banking. So online banking with or without customer consent was being used and activated, and the mobile numbers were that of the employees or someone else, and they could get away around with the ID and theft protection. Product manipulation. Product manipulation included, like we saw in the earlier slide, waiving off fees, creating premium accounts for the Latino customers and then subsequently converting it to a basic account and then subsequently waiving off the fees. Like if you don't have a deposit of 25,000 and you go and waive the fees, waiving off fees or adjusting products to open sales for unqualified customers, steering customers into products that they are not qualified for, or it is not in their best interest to have. The other part is funding manipulation. So there were allegations of team members funding new or existing accounts for the purposes of sales goals. Reassignment of sales credit, that is, there are two teams and one is just on the breach of reaching its target, and so one team member makes a referral to the other team and in need of the sales goal, and thus they meet the goals. Again, invalid sales referrals by directing traffic or inappropriately received by another team when actual sales referral was not made. So there was the judgment, and it was on 2 counts. One is unlawful conduct and second is unethical practices. So the sales goals and accompanying management pressure led thousands of its employees to engage in unlawful conduct to attain sales through fraud, identity theft, and falsification of bank records. And unethical practices by selling products of no or low value to bank customers while believing that the customers did not actually need the products. Collectively, many of these practices were referred to within Wells Fargo as gaming. So gaming was generally known at the bank. It referred to employees' manipulation or misrepresentation of sales to meet the sales goal, receive the incentive, compensation, and avoid negative consequences such as reprimands or termination. Employees created false records and forged customer signatures on account opening documents to open accounts that were not authorized by customers. So after opening debit cards, using customer's PIN without consent, employees falsely created a PIN number to activate the unauthorized debit card. And employees did so because the bank rewarded them for opening online banking profiles, which require a debit card PIN to be activated. Based on the number of PINs activated, which have been referred to the sales customer, he would get a commission or an incentive. So he used the personal information without consent and opened the debit cards and online banking. So in practice, in a practice known as simulated funding, employees create false records by opening unauthorized checking and savings account to hit the sales goals. And then they transferred the funds to the unauthorized accounts to meet the funding criteria required to receive credit for selling the new account. So for this, they use simulated fundings, and they moved funds from the existing accounts to the new accounts to show that, yes, these are the newly funded accounts. So whereas they actually were rotating or unauthorizedly using the funds of another customer for this. Again, unauthorized consumer and business credit card accounts were opened just for the purpose of incentives. Employees opened bill pay products without customer authorization. Okay. Employees encouraged customers to make test or token payments from the bill pay accounts to obtain sales credit, which was awarded. So there were lots of rewards for opening this bill pay accounts or using the bill pay products. And at times they altered the customer's phone numbers, email address, or physical addresses on account opening documents. And so they kind of manipulated lots of personal data also in this case. And they did so to prevent the customers from finding out about the unauthorized account, because the email would go to the incorrect address and they would never find out, or to a fabricated address. So this was the modus operandi over here. You can see one was the false email address which they used, which contained generic and incorrect phone numbers so that they will never know. And second is the simulated funding. Okay. So millions of accounts reflected transfer of funds between two accounts that were equal in amount to the product specific minimum amount. So basically, if the product specified a minimum amount of 25,000, there were lots of transfers of 25,000 itself. Okay. Many of these accounts were because of this simulated funding. In many cases, employees also use their own funds to simulate actual funding that they had opened without the customer consent. So they even use their own funds to open the accounts. So here, the internal auditor was held responsible, and it was testified that in his view, these reporting requirements apply only to the extent that he was aware of something that in his professional judgment rose to the level of being significant. So he said that there were issues, but they were not significant. Further, he expressed the view that he did not bear the responsibility as the chief auditor to escalate an issue if the business unit itself was escalating that issue, and neither did the rest of WFAS internal audit. So under his view, they disavowed any duty to escalate. This is very, very important. Many times during audit, we come across situations wherein the internal auditor points out certain things, and on the auditee comes and says, oh, this is, I have already identified, this is a self-identified issue. Okay. So I don't think the internal auditor should accept such kind of comments. When the issue was not intimated prior to the start of the audit, and it was intimated, the internal auditor has spent time and efforts in finding out the issue, and then has pointed out the issue to the auditee, and then the auditee is coming and saying that this is a self-identified issue, that is completely not acceptable. Okay. The second is, even if it is a self-identified issue, it should be reported in the internal audit. Because if you read this case, Mr. Julian disavowed any duty to escalate known issues to either the A&E committee or the management committee if there was any evidence that the issue was being escalated by anyone else. So he said that it was not my duty to escalate because they had escalated it themselves. So acting in furtherance of these views constituted unsafe or unsound banking practices and a breach of fiduciary duties Mr. Julian owed to the bank. So he was held responsible for not even pointing out the self-identified issues. examination of suspected fraud. So under the Wells Fargo Audit Services Charter, Mr. Julian and Mr. Linko had the responsibility to ensure that effective corrective actions were taken to strengthen reported control weaknesses or uncontrolled risk. Both also were required to assist in the investigation of significant suspected fraudulent activities within the organization. So, sales practice misconduct by community bank team members included fraudulent activity and indicated both weaknesses in risk management controls and the presence of uncontrolled risk related to such misconduct. Okay. So, basically, they were required to assist in the investigation. Okay. And also, there were weaknesses, but it was not pointed out. Another important factor over here, one was the self-identified issue, second was the suspected fraud, and they should have pointed this out, and third is the audit rating. Notwithstanding the repeated red flags raised by corporate investigations, and despite his understanding of the widespread nature of sales practices, misconduct, and fraudulent banking through the relevant period, and notwithstanding his failure to assure the bank that he understood the nature and scope of such misconduct and could confirm that the community bank's first line of defense had identified the root cause of the misconduct and had in place effective controls to mitigate the problem. So the CAE reported that the community bank's risk management controls and culture were satisfactory over here. So this is where it went wrong. So if it was satisfactory, then how come so many issues have come up? How can that particular risk management controls and culture be satisfactory? That was what he was questioned for. There were instances in the audit report. Now the remedial action plan. There were instances in the audit report where the allegation or case did not warrant reporting to corporate investigations, even though there was an evidence of banker non-compliance with proper sales procedures. In these instances, the sales quality team issued emails to regional management instructing them to perform coaching or provide training to the applicable team members. So metrics on cases resulting in training email notifications did not differentiate between first time and second time training notifications. So here there was an issue that there were training email notifications were there, and the first time or second time there was no differentiation in between this. The next is failure to escalate. Audit director was convinced there was a systemic issue with sales practices, misconduct, sometime after the filing of the city's lawsuit, but never went to the bank's board to escalate the issue. Audit's responsibility to identify the root cause of risk management issues. So in this case, the Wells Fargo Audit Service were not required to identify the root cause of the practice because tasking audit with identifying the root cause would not be consistent with the audit responsibilities. So IA believe that if a business unit identified an issue or if an issue was identified by investigation, it was the responsibility of the business unit, not the auditor, to identify the root cause. So here also, this was found to be lacking, which is a very blatant kind of a thing. That root cause the auditor has to identify. So fraud risk. So this is just an explanation of the earlier gaming activities which the sales team was doing. So this was classified and should have been even discussed in the fraud risk committee, but it was not discussed. That was the issue. So looking at this case, probably the only real mistake is the one from which we learn nothing. So this is a sentence by Mr. Henry Ford. I would say only real mistake is sometimes being on the defensive on the auditor's side and not taking adequate measures or considering that these issues are not significant or giving explanations that these are self-identified issues and don't need an escalation. The third is a very important case, an Indian bank. It's a case of a leaky app. Now, the leaky app over here, so why is it important is because internal audit, more particularly, is not only taking out reports, but also auditing the system and checking the system logic. Okay. So it started with an innocuous reward, and there were poor application security. There was this application, and there were incentives on getting number of people onboarded on this application, because of which there were fraudulent manipulation of technical loopholes. Many people, I mean, they have taken the mobile numbers and used one device and done multiple logins into that particular application just to show that yes, people are using this app. But there were lack of security like device binding to ensure that yes, different people are using the app or same person is using the app. Because if you have device binding, then there is a control that okay, not more than X number of person, not more than 3 persons or 3 mobile numbers can use the same device. Okay. In a normal sense, also like device binding is very, very critical. Inflating number of registrations by multiple linking of the same mobile numbers. Even that was the issue. Multiple linking of same mobile numbers. So the questions to be raised is, was the app audited for technical control? So here, essentially, internal audit could have played a role. Was device binding in place? Was the mobile number unique? Or was the same mobile number used to create multiple login IDs? So that is something which is a system control, which should be built into the system. And how the accounts were authenticated. So let us take a look at the regulations. The SEBI Committee on Disclosures advises SEBI on matters. It says in the clause 49 that function of internal audit must be mandatory and carried out by an external audit firm. But however, it could not reach on a solution for this. And it said that the internal audit may be carried out by external audit and views on this are solicited from the public. But sometimes it may be more convenient to have internal auditors, internal in-house, and it should be reviewed by the audit committee. Let's take a look at the regulations. As far as Companies Act is concerned, the whistleblower complaints. So there's the CARO Order 2020, which has asked stat auditor to ask for the details of the whistleblower complaints that were raised and how the due diligence was done. Again, it is mandatory for the companies to share all the whistleblower complaints that were registered with the internal audit committee during the course of the year. And third is the RBI regulations. RBI regulations for risk-based internal audit, which also calls for an independent internal audit function, which should not be outsourced, but which should be in-house. Yeah. So what are the lessons that we learn from this? The first is the safeguards and protections should be put in place for those who fulfill the obligations. Because see, it is very easy to have a whistleblower mechanism, but even if there is a whistleblower, what is the protection which is offered to the whistleblowers? If the whistleblower is required to, disclose his identity, is there a protection given? So managements and boards do not enable or even permit that kind of scrutinies because, they don't want and will not tolerate an internal audit function that is actually expected. So this is a challenge and a call to action because this is what is the expectation from the auditees, which is totally opposite as to what the regulator wants. This is an area which should be treaded very, very carefully. Yes. Next, I want to talk about this concept called greenwashing. Okay. So which is in India, environment scores create a sense of suspicion. So I mean, this year still, I would say the pollution levels are much lower than last year. But yes, sometimes when you see the annual reports of companies and see that all claims with respect to the ESG, you start wondering whether what's on paper, it's actually in the air or what is exactly happening. So greenwashing is this concept. I just want to dwell a little on this concept. So what exactly is greenwashing? As per the Cambridge Dictionary, it's behavior or activities that make people believe that a company is doing more to protect the environment than it really is. So it makes people believe that company is doing a lot of things to protect the environment. So these are 3 examples of greenwashing. Plastic package containing a Shaw container is labeled as recyclable. It is not clear whether the package or the shower curtain is recyclable. In either case, the label is deceptive. If any part of the package or its contents, other than minor components, cannot be recycled. An area lug is labeled 50% more recycled content than before. In fact, the manufacturer increased the recycled content to 3% from 2%. The message conveys the false impression that the rug contains a significant amount of recycled fiber, but it's only from 3 to 2%. A trash bag is labeled recyclable. Trash bags are not ordinarily separated from other trash at the landfill or incinerator, so they are highly unlikely to be used again for any purpose. The claim is deceptive because it asserts an environment benefit where no meaningful benefit actually exists, because they are not used again. Once it lands over there, no one is going to be using it back. This is another case, one Mr. Trevor Milton, the CEO of a company called as Nikola, founder of an electric truck company. So Nikola was an electric truck company, and the main business of the company was into trucking, which was a eco-friendly or a ESG-friendly method by having an electric truck. So Mr. Trevor Milton was the CEO, was engaged in a scheme to induce investors, particularly individual, professional or retail investors, purchase the Nikola stock based on misleading and fraudulent statements and disseminated through social media, television, print, and podcasts. And Milton made false and misleading statements regarding nearly all aspects of the business, which was to design and manufacture zero emission battery electric and hydrogen electric vehicles, electric vehicle drivetrains, vehicle components, ESS, and hydrogen station infrastructure. These misrepresentations include the following. So here, claim was made that a particular vehicle, could on its own it could achieve traction, wherein actually it was taken at the top of the hill and it was not self-propelled. The truck was not self-propelled, and that was used as an advertisement. And one of the short sellers, one of the famous short sellers, had pointed this out, and post that, Mr. Trevor Milton had faced the fraud trial. So there were false and misleading statements that Nikola had early success in creating a fully functioning semi-truck prototype known as Nikola. False and misleading statements that Nikola had engineered and built a electric and hydrogen-powered pickup truck known as the Badger from the ground up using Nikola's parts and technology. So there was lots of fraudulent statements regarding the technology used and regarding the functions of the products. And based on that, the stock was bought in the market. So there were false and misleading statements that Nikola was producing hydrogen and it was doing at a reduced cost, wherein there was no such truth. False and misleading claims that reservations made for the future delivery of the semi-trucks were binding orders. So they showed a big order pipeline, wherein there was no such big order pipeline. So this is just an excerpt from the particular case. Also, the social media was rampantly used. However, there were no internal controls and process for monitoring as to what are the interviews and social media activity, whether there is any truth or it's false. Mr. Milton did not consult with anyone in Nikola before publishing the related information. Likewise, no one reviewed the social media posts, for the Nikola did not correct these statements. Again, Nikola does not design, implement, or maintain disclosure controls as to what is going into those social media. Similarly, they do not have a processes in place. So also I would like to come back from these 4 cases, which we just saw pertaining to cryptocurrency and the leaky app, the ESG related false claims. Okay. So these 4 cases, what we can draw from it for India. So coming back to the banking domain, so RBI has issued a circular in July 2024 pertaining to fraud risk management, and there are lots of important aspects in this circular, both for external as well as internal auditors. With respect to credit facility or loan or other transactions, RBI wants that if there is a suspicion or indication of wrongdoing or fraudulent activity, Then the NBFCs shall monitor, and RBI has in fact given a lot of power in this case to NBFCs to use external or internal audit to audit these credit facilities for further investigation. And for this purpose, they have said that even the loan agreement should contain a clause that the lender can at any point of time go and appoint an external auditor and internal auditor, and the particular borrower has to cooperate for doing the particular investigation or audit. So the contractual agreement, further the agreement with the auditors, if any, it should also contain a timeline for completion of the audit and submission of the final report. Further, in cases where the report is non-conclusive, okay, due to non-cooperation by the borrower, then in such cases, the NBFCs can conclude on the status whether it is a fraud or it's not a fraud, based on the material available on record. So it leaves the conclusion part to the NBFC. Also, the role of auditor needs to be highlighted over here. So during the course of the audit, auditors may come across instances where the transactions point to a possibility of fraudulent transaction. In such a situation, the auditor should immediately bring it to the notice of the senior management and, if necessary, to the audit committee of the board, okay, for appropriate action. So it's also the auditor's responsibility. Also, it is also the auditor's responsibility to cover controls and processes involved in prevention, detection, classification, monitoring, reporting, closure, and withdrawal of fraud cases, and weaknesses observed in the critical processes in the fraud risk management framework. This is just a taxonomy of the business risks and important aspects appearing in the risk domain pertaining to geopolitical and environmental risk, especially. So as of now, I will skip this slide. So we have come to the end of the session. I hope you enjoyed the session. So Aditi.
Hello.
Yeah, hi, Aditi. So if there are any questions, can you let me know?
Yes, Archana ma'am, we have the questions. Myself, CA Daya Bansal.
Yeah.
And during the session, we received 4 questions.
Okay.
So out of them, first, the member is asking how we can use the AI in internal audit.
So there are many ways of using AI. Although this question is not relevant to the topic which is under discussion, but AI is relevant, is very much relevant today, and you can frame observations, or you can get inputs on the internal audit observations directly from AI or Chat GPT or ICI GPT. Those results may not be absolutely correct. It may be very generic, but yes, they can be used, and no more, language is no more a constraint, given the fact that AI can write your audit report also. But yes, I mean, you cannot just blindly rely on that, because what it gives is it just accumulates things not in generic in nature, but you have to do your own checks.
Yes.
Yeah, just a few. I mean, I just read a news article that the HR team in a particular organization was fired because they had AI in their HR process, and the one of the HR managers, he put in a fake CV of himself and uploaded it. However, he did not get shortlisted. So that is because the logic, the system was given to identify people having a particular software knowledge, but the logic itself was incorrect because the name of the software was given incorrectly. Hence, it was kind of rejecting all the applications. So AI can be used with a little bit of human intervention is definitely required.
Right.
Yeah.
Ma'am, we have one more question from the member.
Yeah.
That they want some cases where the auditor are punished in various countries, whether in India or outside India.
audit, I mean, nowadays the auditor's task is that of, walking on a thorns, because uh, many times the auditees, they have their own perception. The board of directors, they have their own agenda. And the auditor, he has to comply with all the guidelines, but the other stakeholders do not understand. Okay. And hence the auditor faces lots of pressure for this. So, I mean, the case which I covered over here, uh, you can see that the auditor was heavily fined, which was the internal auditor was heavily fined. And it's a similar case only. Hope this
Okay.
answers your question.
Yes, yes. And the members want the like cafe coffee day and banks fraud, all the case study if you can share, so it will be helpful for them.
Well, I have not included that in my slide, but there are many good books which have been written uh, on these cases in India, but I have not covered those cases in this particular presentation. Well, that's for another day. But I can definitely suggest some books, and you can refer them to the members.
Right, right.
Yeah.
Archana ma'am, your session was super up. So, on
Thank
behalf
you.
of I would like to extend our heartful gratitude for sharing your expertise on the internal audit with us today, and your insightful preparation and engaging discussion, valuable perspective contribution have greatly enhanced our understanding on the internal audit principle and the best practice. The way you present by the PPT, each sliding is also very interactive. So we really received a good knowledge by your PPT. And thank you so much on behalf of ICI and behalf of all the members and all the committees members of the Board of Internal Audit and Management Accounting. I really thank you to you.
Thank you so much. Thank you, Daya. Thank you, Aditi. Thank you, Arunji. And thank you to our chairman. Yeah, thank you so much.
Yeah, thank you. Thank you, ma'am.
Thank you.
Thank you. Have a
And
great
I
evening.
would like to thanks to each and every member who joined today. Thank you.
Thank you.
Yes, yes, sir.